PayPal just had the second worst day in its history after their earnings call this week, and the stock crashed by over 20% in just one day and is now trading close to the IPO price. But the price drop is not even the scary part. It's what the CEO didn't say that should have investors terrified. Hi guys, and welcome back. My name is Florian and I'm a physics engineer from Germany with a passion for data-driven and objective investing. In today's video, I will break down the latest earnings call from PayPal to see if the stock is dead or if the recent crash is a unique opportunity. Welcome to the channel and thank you for joining me today. So, PayPal stock just crashed by 23% after their disappointing earnings call. This leaves the current total one-year return at a negative 47%, well below that of the S&P 500 that returned 15.5% over the same time. And yeah, the earnings call wasn't good, but does it really warrant such a drop? Well, on first glance, the numbers they reported are not good, but also not so bad, right? I mean, most metrics here still show growth. But unfortunately, this is a bit misleading. The EPS and revenue, for example, while still growing, were well below the expectation from Wall Street analysts. The revenue was at least close, with only 1.2% below expectations. But the EPS was a catastrophe and came in 4.5% lower than expected. This is quite a bit and shows that PayPal, while still technically classified as a growth company, is not growing as they should. What we also see is that the growth in the last quarter was generally lower than those of the whole year. And the last quarter was the Christmas and holiday quarter that is usually pretty strong for these payment services. So a slowdown in exactly this quarter is indeed a pretty bad indicator. Especially the falling transaction margin dollars is pretty bad because this means that while their revenue might still grow, the real profit that PayPal makes after paying banks and other card networks like Visa and MasterCard is indeed under pressure. So especially the high margin parts of the business are doing really bad. But not only the finances were underwhelming. The same is true for their account and activity metrics. The monthly active users did barely grow at all, and the number of overall transactions is even going down on a year-over-year basis. And while PayPal states in their comments that the transactions per account ex PSP, which excludes unbranded card transactions and accounts, is growing at 6%, this is still a problem. Let me show you why. Most of this growth is actually coming from Venmo and P2P, which were the only parts that were still growing with double digits. But these parts are expected to have the lowest take rates or margins from all of their segments, while the branded checkout has the highest, but is actually growing the slowest. Now, their management acknowledged that they had some operations and deployment issues, but also cited macroeconomic headwinds as primary risk. But if there are macroeconomic headwinds, this should affect the whole market, and other players should see the same effects, right? So let's have a look at how Visa and MasterCard did in this regard. But before we go there, I have some exciting news to share with you. Because I just set up a Discord channel for this community so that it is easier to directly discuss investing and stocks. The comment section is great and all, and I appreciate every single one of you who leaves suggestions or comments there, but it is not the right place for discussions. I will also share some exclusive quick analysis on the Discord channel, like here for D-Wave Quantum, for example, where I basically just gather and share my research and information of stocks that I look at. So if this sounds interesting to you, please feel free to drop by. The link is in the description below. And the best thing is, it is completely free, no strings attached. So it's a very safe investment, so to say. But enough of that. Let's get back to how PayPal compares to Visa and MasterCard now. First, Visa reported that their growth in processed transaction was pretty strong. Pretty strong in numbers means that the payment volume grew by 8% and their processed transaction with 9%, both in constant dollars. So the volume grew 2% quicker than PayPal's, and while the transaction growth at PayPal was negative, Visa still shows a strong growth here. But the real PayPal killer is Visa's direct transactions that directly competes to Venmo and PayPal's P2P segment. Because for Visa, these direct transactions grew by a whopping 23%. So quite a bit above PayPal's growth. And for MasterCard, the picture looks pretty similar. Their volume grew even a bit quicker with 9% on local currency basis. And the transactions that they call switched transaction here even grew the quickest of the three with 10%. So why PayPal's management wants us to believe that consumer spending is the problem? I don't actually think so. And this also shows when we look at the general market forecast for the greater digital payment market. Because this market is also expected to grow by 21.4% until 2030, while PayPal doesn't even come close to this growth as we just saw. So, while 60% of the global population are expected to use digital wallets in 2026, PayPal seems to fall more and more behind. And internally, PayPal seems to recognize this because they also just fired the CEO after just 2 years and hired Enrique Lores, the former CEO of HP. Unfortunately, I also think that this is not a good idea and really shows the bad spot that PayPal currently is in. But I'll come back to that in a second. First, let's finish the company report and look at the guidance for the next year. And unfortunately, it doesn't seem to get better anytime soon. The only value here that is in the double digits is their tax rate. They think that their transaction margins and their EPS will even decline next year. The only positive thing I see here is that they want to buy back shares worth $6 billion. But that is also roughly the amount of their free cash flow that, by the way, was $6.4 billion in 2025. And the way they stayed here with $6+ billion rather tells me that they also think that this will go down. I think what we are seeing here is essentially financial engineering at its finest. Because by spending all of their cash flow to reduce the number of shares, they can make the EPS look stable or even a little bit growing, even if the operations and net income are stagnating or even falling. Now, I also just said that I think that the new CEO is a bad idea or at least not a good sign. And I have 2 reasons for this. The first is that HP, at least in my mind, is a stable and mature company and not a growth company in the way PayPal is. So the playbook for them is completely different. And second, when we look at the stock chart and the income metrics from HP, this is not what a successful growth business looks like. So I am not sure what they are expecting from this move. Maybe they are preparing their transition to a slow death by 1,000 needles while still buying back shares. I, for myself at least, don't like this move even a single bit and don't think it bodes well for the company. So, last but not least, let's also have a quick look at PayPal's financials and also rate them with my stock scoring system to get a more objective view. And if you like the video so far and maybe even learned something that you did not know before, please consider hitting the like button and maybe even subscribe to the channel to not miss my next analysis. This way, you are also telling the YouTube algorithm that this video is worth watching, so it gets recommended to a larger audience. With the way I am researching companies, I just can't post 3 videos per day like some other finance YouTubers do. So every single like and subscribe really helps a lot to keep the quality up, especially since we are still a small channel. Now is also a good time to subscribe because for the coming year, I want to increase the amount of videos without reducing the quality. So thank you very much. So let's go back to the financial analysis. And when we look at the income history on a quarterly basis in my TradingView dashboard, we see that yes, the revenue is growing. But the growth was pretty slow, not only last year, but basically since 2021, 2022. And the same is true for EBITDA, net income, and free cash flow. Only the EPS still shows a nice uptrend, but as I just explained, this mostly comes from them buying back shares, not from great operations. In my stock scoring system, this gets them a total growth score of 6.2 for 5 years and 6.3 for 10. And I will not go too deep into the individual scores in this video because first, I can see that many people are clicking the video away when I do, and second, this video is not a deep dive. I mostly wanted to look at the last earnings call. So sorry for everybody who would like me to go deeper into the details here, but if it is any excuse, this is exactly what I do in my deep dives. Next comes their balance sheet, and at least this is quite clean, with a net debt to EBITDA ratio of only 0.2 and an interest coverage ratio of 14.9. And here we can also see again their crazy share buybacks. They are indeed buying back a lot of shares, which I would generally like. But combined with the stagnating growth in PayPal's case, I am not sure what to think of it. Maybe this money would be better spent reinvested in growth. And up to now, their margins have mostly been pretty stable, but with the latest numbers, I'm really wondering how long this will stay like this. Only the free cash flow margin has already declined for years. At least the ROIC is going up, which looks good at first glance. But again, by using their cash to essentially delete shareholders' equity with share buybacks, they make the existing profits look more efficient even if the business is not growing. This is the classic playbook of a company that has run out of growth ideas. So maybe I'm wrong and the new CEO does indeed fit better than I first thought. Unfortunately, still not in a very good way. But in my scoring system, for health and profitability, they get quite a good score of 7.8 for both timeframes, which at least shows that they are not in any kind of financial danger right now. But this is also a drawback of using a quant system, because it only uses the numbers itself without context. And as I already explained with the ROIC, I think that the numbers we see here are a bit misleading. But hey, to cover for all the red flags, PayPal at least announced to pay a dividend from now on. The yield is not even bad with 1.3%, and the cash flow payout ratio is also still pretty low. But of course we don't have a growth number or any kind of history for this yet, so they only get a 4-ish score in my scoring system. The quality score is also not half bad, with 6.5 for 5 and 6.2 for 10 years. But this mostly comes from a strong secure growth and a high score in manager quality that comes from their high ROIC, share buybacks and dividend, which is again all a bit deceiving in my eyes. The momentum is also in the gutter after the crash, but this also leaves the valuation pretty low overall. Here, PayPal gets a 5-year score of 6 and a 10-year score of 8.2 because of the low valuation. And the valuation is also pretty cheap when we compare this to their own 5-year history and is well below the averages. In fact, it is currently 50 to even 70% below the averages, depending on the metrics, which mostly comes from the pretty high valuation they had back in 2021 and 2022. So all in all, PayPal gets a 5-year score of 6.4 and a 10-year score of 6.7 in my scoring system, which is at least decent. But yeah, even though the score doesn't look too bad, I still think that the company still first needs to figure out how to get back to growth to compete with the big boys like Visa and MasterCard before even being considered as an investment. And I do indeed realize that my view today is pretty pessimistic. More so than I would like myself, to be honest, because I am trying to be as objective as possible. But the fundamental picture that I'm seeing is just not very good, with a couple of red flags. But as always, this is just my opinion. So what do you think? Do you agree with my thoughts? Or do you think that the new CEO can indeed turn the company around? And guys, I am trying to be fully transparent about my investments here on this channel. That is also why I share my full portfolio, including all actions that I do here. Last month, for example, was pretty mixed, with 3 of my companies crashing by over 10% and 3 others going up by over 20%. So if this sounds interesting to you, check out this video right here. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.